Welcome everybody to BAM's Multifamily 2026 Outlook and Conversation. I think we called it a webinar, but we wanna have this as a conversation for everybody who's joining with us today. So I see a bunch of familiar names and faces. So welcome everybody. If you don't know me, my name is Nick Meyer, and I am my title is the Vice President of Capital Markets. So my team, we get to work with a lot of you, which is why I know a lot of your names. So you would know probably very familiar with a lot of names on my team, from Max to Andrew, uh, and on down. And Catherine Herron, of course, is phenomenal that you probably worked with as well. So very excited that you're all here, and looking forward to the conversation today with you all. We have a great, I would say, a great guest list joining us today, who's going to be presenting on our team, who spends a lot of time thinking, reviewing, talking, discerning of what are we looking at? What are we buying? When's the right time to sell? How do we view that? What's happening in the market across the US, but also specifically where we are, where we focus. And if you've invested with us or been talking with us anytime recently, it's the Midwest. We love the Midwest. It's our bread and butter. It's where we're from. It's where we're based here in lovely Carmel, Indiana, adjacent to Indianapolis. And yeah, excited for the conversation today. So we're going to do a round of introductions with the team who's gathered here with us, and then if you've ever been on Zoom or a Google meeting or whatever, the chat is open, and so we would love any questions. As we're having the conversation, as we're doing that here in the first 15 to 25 minutes, as we're sharing insights and information, laying the groundwork. If you've got a question that's prescient to the topic that is being talked about, throw it in the chat. And my job is to see that and then to share that with Jim and Alec and Ryan. And then as we kind of get to the end, we will have a Q&A as well. So if you're thinking about things but you don't think about it till later, we're gonna have plenty of time for that at the end. And this is for all of you. Of course, it's an opportunity for us to share what our knowledge and experience and expertise is, but really at the end of the day, it's for you and the things that you're thinking about, you're hearing, you're reading, and you're seeing, and how can we speak into that? So, without further ado, I'm gonna kick it to Jim Fox, who's our CFO. And Jim, would you give an introduction and then pass it over to one of our other colleagues?
Absolutely. Well, thank you everyone for joining. I always appreciate opportunities to interact with our investors and appreciate your time. I'm hoping, as Nick mentioned, that it's interactive. I am the CFO. I've been here about a year and a half and gotten to know a handful of you, but looking forward to doing more of that. I've spent my entire career in real estate, so I've got a pretty good depth of knowledge about the industry. Hope to be additive to this conversation. Ryan?
Yeah, I'm Ryan Thie, Vice President of Asset Management here at BAM, oversee the firm's acquisition, disposition, financing, and portfolio management activities. I'll hand it off to Alec.
All right. Hi, everybody. Thank you for joining. I am Alec Bannister. I'm the acquisitions manager here at BAM. I've been with the company for about 2.5 years. I've been in the industry 7 plus. I'm an Army veteran before that. So having a great time with BAM and really trying to find our next acquisition opportunity. And what we're going to talk about today reflects how we do that.
Yeah. Awesome. Thanks, guys. And just a quick level setting for everybody. Again, I mentioned there's a Q&A at the end, but what are we going to be talking about? And I put the high level things here. And if I can just get a shake of the head from a few faces I see, can you see my screen that says agenda at the top? Yeah, love it. Okay, great. Technology, you always want to make sure we're on the same page with that. But we'll kick it off with the team and talking about the National Multifamily Housing Council. There's a big event that happens. These guys are going to dive into that. Who, what, when, where, why, and how, why it matters. And then we're going to talk about the key takeaways from that, but also what have we seen, where are we at right now, and what do we see coming in the future as well. So that's all laid out there to help guide the conversation today. Okay, with that, now, I don't know I can't remember who's going first. Is that Thie or?
Yeah, I'll start us off.
Okay.
So talk a little bit about NMHC, the National Multi Housing Council. To kind of get into it, before I get into NMHC specifically, just to talk about industry engagement, something that's very near and dear to BAM. We have a really deep industry, the multifamily industry, or the apartment industry, as it can also be called, between the capital, both the debt and equity side, owners, operators, management companies, vendors. It's a really deep industry with firms and people. It's throughout the country. And we're really fortunate that our industry has both strong national and local level groups that look out for the best interests of our industry, because it's simple yet very complex and difficult to execute what we do every day, which at the end of it all is critical infrastructure to our society. Everybody needs a place to live. Shelter is a human necessity. That's never going to change, at least as long as we're all roaming this earth. But our industry, I don't want to say I mean, I'll simply say it's got a little bit of a target on its back with the conversation of housing affordability. A lot of people have a lot of different ideas on how to combat that. Some of them are logical and rational, and some of them not so much, but they will help people get votes and sound good to people that maybe aren't as educated on the matter. But we're really fortunate that our industry does have great organizations that educate our elected officials, our leaders, and even the general public on how our industry works and what's in the best interest of all Americans to have a great quality place to live, which at the end of the day is what companies like BAM and our peers in this industry want to provide. So with that, it kind of segues into the NMHC, National Multifamily Housing Council. So that's an organization that's been around for, I think, a good 40 plus years, based in Washington, D.C., and they are really the thought leadership and advocacy arm for the apartment ownership, really the capital side of the multifamily industry as a whole. Its member firms are firms like BAM that invest in apartments anywhere in the country. I mean, all the REITs, all the household names in private equity, all the way down to mom and pop developers and small towns across the country and everything in between. But the NMHC really does a lot of work representing kind of the ownership and capital side of the industry. There's another organization called the National Apartment Association, which BAM is also a proud member of, and all of the state local apartment associations like the Indiana Apartment Association, which BAM is a proud member of. I'm actually on the board of directors there. We have a pretty robust presence in Des Moines, Iowa, the Greater Iowa Apartment Association. We have one of our regionals is on the board of directors. We have tons of people on committees throughout the company on these local associations, but those bubble up to the NAA, the National Apartment Association. That group is very focused on the property management and operation side of things, where a lot of their big issues, rent control is a big issue that both the NMHC and NAA really work to combat, but they're also very focused on fair housing and just navigating the logistics of the day-to-day operations of the apartment industry, which is a whole another world in and of itself. But the NMHC very focused on the capital side of it, especially for owners, developers. They really want to make sure that we're able to continue to provide quality housing for all Americans. And again, it's critical infrastructure. But I'll kind of hand it over to Alec, who will talk a little bit more about how the NMHC's annual meeting is a key date every year in the multifamily industry calendar.
Right. Thanks, Ryan. Yeah. So our involvement is important for a number of reasons. Our physical presence is, I would say, even more important at this annual conference. We have brokers, think real estate agents in each of the markets that we operate in. We're in 6 different states. Within those states, there are your household names: Cushman and Wakefield, CBRE, Colliers, Walker and Dunlop, MMG, Berkadia, and so on. So having relationships with each of those brokers is really important for deal flow, getting access to new opportunities, getting just data, and being able to digest that. So those relationships are really important to us. So at the annual conference, that is our opportunity to, at least for me, to have to, I'm able to sit down with each of our brokers that represent us or that have brought us opportunities. It's a one-stop shop to do that. Throughout the year, I will travel to those, respective markets that we're in or we want to be in. Kansas City, Northwest Arkansas, Des Moines. But this is an opportunity where the Des Moines brokers, the Kansas City brokers, Northwest Arkansas, Pittsburgh brokers, they're all in the same spot, and we can meet with them and avoid the travel costs that would otherwise be there if this conference wasn't a thing. On a more broader scale, it really kicks off the capital markets cycle for the year, and that's case in point why it's hosted in January. It just really sets the stage for what the market is expecting in 2026. So each broker will typically bring a showcase opportunity to the annual conference. And then they will also, depending on our relationship with them, which I'd like to think that our relationships are strong, they will give us a sneak peek of what's coming in Q2, Q3, the rest of the year. So if I'm doing my job right, I'm already aware of the opportunity that they're going to bring to the conference and then what's coming. So this is really an opportunity for our team to sit down with those representatives and dive in a little deeper. And then lastly, I'll say getting the BAM brand out there is really important to us. Building our reputation, maintaining our reputation, just showing who we are, what we're about, and where we want to be. And this is an opportunity every year to do that, build off the previous year, and kind of set the stage for us in the market for the following year.
Yeah, I think I would like to just follow on after Alec and explain a little bit. Obviously, as stewards of your capital, you depend on us to really understand what's going on in the marketplace. NMHC, they as Ryan mentioned, there's a day of presentations from really industry-setting thought leaders, with deep research teams who really understand which direction the market's heading and so forth. So, on top of that, obviously, we're there kind of really solidifying the relationships that Alec mentioned, and making sure that when a deal is thought of in August, BAM is top of mind. It's important to us that we get a first look at deals. In fact, the last two deals that we did in Fund 5, were deals that Alec did that had either previously been marketed but weren't currently being marketed, and it was a limited look that led to our buying those properties. So, NMHC and the beginning of the calendar real estate year, as it were, are really important for BAM to be a meaningful participant in.
Absolutely.
That's perfect. Thanks, guys, for laying the foundation there. What are some of your key takeaways coming out of that? You talked about relationships, data, right? Leading experts that you're hearing. Obviously conversations with brokers, markets. What are some of the key themes and key takeaways that you had from the conference out there?
Well, Jim, I mean, you and I were talking about this. I think a big thing that came up in 2025 or coming up on a year of it was tariffs and inflation, the impact that would have. Again, NMHC having a lot of developers at that conference, the cost of construction, cost of labor, cost of materials, all of that, very much on the forefront of their minds. I think, Jim, overall, yeah, there's been some pullbacks in what developers are underwriting for their construction costs, and their assumptions are getting a lot more conservative. But some anecdotes that I've gotten are that, yeah, they'll underwrite a 3 to 5% impact on tariffs, but what they're really realizing is closer to 1%. And further, there's been a big pullback in subcontractors because of how their work has really dried up the last couple of years with increased interest rates, development capital equity becoming a little bit more scarce, and construction starts falling off. But their pipeline of work is not great, so they're getting a lot more aggressive on pricing. There was one developer I heard anecdotally that they've seen a about a 20% fall off in some of their subcontractor costs, which is really interesting, given that everyone thought that prices would skyrocket after all of these tariffs that were implemented over the course of the last year, when in reality, a lot of that really hasn't had massive impacts. They're there, but wouldn't you agree, Jim? They've somewhat been priced in, and
Yeah. I think the shock of Liberation Day probably created a lot of fear. And if human nature is any indication of how people would behave, they probably overreacted a little bit to what was really gonna occur in the market. I think inflation still being present is a little bit like the interest rate environment where a little bit of inflation is kind of baked into the forward-looking projections and how people are looking at the viability of new deals going forward. And so, yeah, I think the tariffs weren't as bad as expected or feared, and inflation is sort of being priced in. And so I think the market has calmed down by and large. And obviously people are, since COVID came, we had a little bit of supply chain concerns, and I think tariffs kind of exacerbated that, and that never really came to pass either. So, and then the other things that we saw, we talked a little bit about the debt capital markets and then the equity capital markets. The equity capital markets, I'll talk about those. You know, Basically there was a ton of capital raised in anticipation of some coming distress in the multifamily market. Frankly, a lot of people, we use debt as part of our capital structure. And when interest rates spiked, beginning, after 21, 22, 23, we saw a precipitous rise in interest rates. Most people do loans of 3, 5, 7 years. A lot of those loans are coming due, and there was an anticipation that there would be a lot of distress because people wouldn't be able to replace that debt. And I think that while that was by and large true, it has sort of, a lot of lenders were kicking the can down the road, and that distress never came. So the capital that was raised for real high octane distress type investments is still there, but it's more or less sitting on the sideline. From an equity standpoint, a lot of the owners who do have capital, they're being very discerning as we are at BAM. We're picking and choosing our opportunities carefully. Maybe you can expand on the debt capital markets and what we're seeing there.
yeah, on the debt side of things, that was really one of the more eye-opening takeaways from the narrative at NMHC this year, was that really debt, we rewind 3 years ago, it was very hard to come by. Rates were high, underwriting standards were very high, spreads had widened. And now I think what we're going to start to see this year, based on what I'm hearing, is that, yeah, rates still might be elevated relative to what we were used to 4, 5, 6 years ago.
Yeah.
Really shorter term product is going to be very much in vogue. If you look at where the 5-year treasury is versus the 10-year treasury, there's a pretty sizable margin there. And then SOFR, there was a time where the 10-year treasury was below that. SOFR, secured overnight financing rate, which is what a lot of floating rate debt on real estate is based on, that's lowered meaningfully with some of the rate cuts over the last 18 months, where short-term debt's attractive, short-term agency debt's attractive. Yeah, there's still some groups out there that'll go for 10, 12-year agency deals, or they'll go for HUD even, where it's 30, 35 years. But more short-term optionality is becoming more in vogue. And with that, a lot of that short-term lending is coming from banks and debt funds. A lot of capital has flown into the debt funds because in the part of the cycle that we've kind of been in the last couple of years, where, yeah, the returns on credit are almost a little better than the returns on equity, if not better. And that a lot has been raised for these debt funds, and there's so much liquidity in that segment of the debt market, the debt capital markets, that debt funds are really giving the banks a run for their money, and banks are going to have to get a little bit more aggressive on terms. So that's something we're going to be keen to look out for. I think it's going to benefit us in the sense that we can probably, rates are what they are, but terms are going to be a big thing. Whereas 2 years ago, we didn't have a lot of say in that. But
Right.
don't let it be mistaken. A lot has changed from where we were 4 or 5 years ago, where it's not, it's not frictionless lending is a bygone era. Banks are definitely going to prioritize sponsors with great track records and good real estate. At the end of the day, they will hang their hat on that more than anything. They'll still be tight on underwriting. They've learned a lot over the last couple of years, but track record and real estate are going to be key to get those competitive terms across all these different debt platforms.
Yeah, and anecdotally, Ryan, some of the recapitalizations that people are looking to do are a little bit harder if they either don't have adequate reserves or they over levered a project, a few years back when interest rates are lower. That's considerably different than a new project that they're putting new financing on.
Absolutely.
So, yeah.
Well, I do want to be mindful of the time. I know we want to leave as much time as possible in the Q&A here at the end. So I think we'll kind of kick it over to Alec. Maybe if you want to talk a little bit more through kind of the supply and demand was the other big thing, and obviously a hot topic within our industry with really more apartments being built in the last couple of years than there were. I don't want to say the whole 50 years prior, but at any point in the last 50 years, really the early 1970s was when we saw a big wave of apartment supply, bigger than what we've seen in the last couple of years. So maybe you can touch on kind of where the fundamentals of the industry were in 2025, and we'll kind of get into what we think 2026 is going to look like.
Yeah, definitely. Nick, do you mind sharing the slides, please? This would be helpful. So really, another takeaway from NMHC, and this is also one of our predictions, is transaction activity, transaction volume in 2026 relative to 2025. We expect it to increase this year. That is shared. When we were at the conference, that was shared. We expect it to increase this year and continue to increase into 2027. So what that means, and there's a couple indicators there to point to that. Number one, just the sentiment. Last year at the conference and the year before, it was we're expecting some of the same, or we're expecting transaction volume to dip a little bit with all of this supply coming in. So this all plays into each other. But I looked back at the data that we have in-house. And Ryan, I'm going to throw you a little quiz here. All right. So January 2025 or January 2026, right? So last month, we had 10 actionable opportunities, Class A multifamily deals in our target markets. How many do you think that we had in January 2025? The year prior.
I feel like it's a trick question.
It's not.
I mean, yeah, no. I'm going to say 0 because really everything kicks off at NMHC. It all starts to really pick up right then, not a minute sooner.
So officially 0, unofficially we had 3 because we had early access to the deals that were coming at NMHC. So there were 3. So snapshot in time, this year versus last year, January 2026 relative to January 2025. The transaction volume has already tripled, at least opportunity-wise, right? So we expect that to continue into the rest of the year. And I wanted to pull this graph here from CBRE Midwest. This is specific to the Indianapolis MSA, where we're headquartered. You can see 2022 peak volume over the last 10 years, significant dip into 2023. And then really from 2023 to 2025, it was about the same. And again, that plays into the second point here that I want to get into is the construction pipeline. So Nick, if you go to the next slide, please. So this chart from RealPage shows quarterly supply by region. And I think this is important to show because we are Midwest owner and operators. So we care, intensely about what's going on in the Midwest. But being able to take this data, the data that we're seeing in the Midwest, and compare it to the rest of the country, you can see it's pretty significant in terms of the incoming supply quarter over quarter since 2015 in the South and in the West when you compare that to the Midwest and even the Northeast. So go to the next slide, please, Nick. And now, with respect to the markets that we are active in, that we operate in 2024, right, supply was up nearly 4% in most of these markets. Kansas City and Pittsburgh a little different. Then we saw an increase across the country, where 2025 was really the peak in the increase in inventory across the country. You can see that was definitely true for Des Moines and for Northwest Arkansas. Kind of sporadic when it comes to the others. But then compare 2025 to what's projected for 2026. Nationally, it's cut in half. And that kind of, that trend follows within the markets that we're active in. So this is why, as the supply pulls back, the new supply coming in pulls back, and the markets that we operate in, and I'll get into this, we feel that the fundamentals are very strong when you focus on occupancy and rent growth. With that supply pullback, those fundamentals should increase in strength. Next slide, please, Nick. And if anybody has a question on one of these, please interrupt and go ahead and ask. But occupancy in our active markets, really anything around north of 90% is good, but the goal is 93%, north of 93%. So again, with the supply peak in 2025, you saw a little pullback in a number of markets, to include the markets that we're active in. Northwest Arkansas, you look at that and alarm bells go off, dipping into 87.5. There was an extreme supply wave that went into Northwest Arkansas, and the catalyst for that was the Walmart global headquarters moving to Bentonville, Arkansas, where our asset, Uptown Terrace in Fund 4, is 10 minutes from. Now, looking forward to 2026, the projection is that occupancy improves north of almost 93%. So that value that we were anticipating, we bought at a good time, and we still feel strongly that the fundamentals within Northwest Arkansas will increase. All right, next slide, please. So with respect to Indiana, we are the Hoosier State. Sorry if there are any Purdue fans on the call, but this really highlights just the strength of Indiana multifamily fundamentals when focusing, specifically on occupancy. I mentioned before, anything north of 93% is considered very strong. That is our internal goal, but from a market standpoint, all classes, all multifamily, anything north of 93% is very strong. And as you can see, the Indiana markets that we are active in continue to hold that strength. Next slide, please. All right, so shifting to rent growth, which I know is a hot topic for everybody. Wanted to start regionally first. The main thing here is I've had percentages up on these graphs. This is the first chart that shows a negative percentage. So nationally, we stayed about neutral in 2025, slightly negative depending on the source that you look at. And then focusing on the South, negative 2% rent growth, West, somewhat neutral. But the Midwest is best. We don't boom, we don't bust. steady 2% rent growth in 2025. Again, strong fundamentals in the Midwest. That's where we own and operate. This is an indicator of why we are here. Next slide, please. So with respect to the markets, the specific markets within the Midwest that we operate in, focusing first on Indiana, you can see, Indianapolis continues to be strong. We saw a slight dip in 2025 in Indianapolis due to the supply wave. We expect that to pick back up. Bloomington, intensely strong market. This really, the indicator there, the reason there is their limited Class A multifamily market rate assets within the Bloomington market. So 2025 was very strong. We expect that to continue into 2026, but our prediction is a little more guarded than an 8% rent growth. Fort Wayne continues to be strong. Supply there had a minor impact, but not as heavy as other Indiana markets. And then West Lafayette is experiencing a supply wave still. So we expect growth in that market, but not as strong as in other Indiana markets. And then same with Evansville, just solid market. Not a huge supply wave there that impacted the market. We expect that to be steady Eddie continued growth with respect to rent growth. Next slide, please.
As we're hopping into that, I'm going to interrupt with a question.
Yes,
came in from Chris. So you guys may have seen this. I think this fits it within this. And Ryan, this might jump to you. What's your view? What's our view or reasons for rent reductions? Is it overdevelopment of capacity, pricing pressures on affordability, or are there other factors?
That's a great question, Chris. I think really the simple answer is it's supply and demand rebalancing. If you go, and I know Alec doesn't have it on the chart, but I remember in 2022 and 2023, our rent growth numbers would blow this chart out. Like we were getting 10, 12% rent increases on renewals in 2022 and 2023. And that was because our properties at the time, our assets were 98% occupied. If we're 98% occupied, that's limiting our potential to increase rents. We don't want to be running a wait list. That's why 93% is really that sweet spot. You want a little bit of vacancy so that you do have some room to expand rents a little bit on new leases, because you will naturally have some turnover. There's a reason people rent. They don't live here forever, although some do. But no, it's really a function of, we've added hundreds of thousands of units nationally and saw a massive easing in rent growth from what were unprecedented all-time highs. The average rent growth in Midwest markets like Indianapolis and Kansas City, and I'll say broadly all markets in Indiana, Des Moines, Iowa, is usually anywhere from 2 to 3%. Whereas on those coastal markets, those gateway markets, no offense, Jim, the Chicagos, the New Yorks, the San Franciscos, the Miamis, there are some years, they'll be up 12%. There'll be some years they're down 12%. And they're just all over the map. And but really, to Alec's point, and it's a phrase we use around here a lot, our fearless founder and CEO Ivan Barrett uses it all the time. The Midwest doesn't boom, but she doesn't bust either. But yeah, we even still in the Midwest where we saw more supply than what we're used to. Maybe not the levels that some markets in the Sun Belt, the Austins, the Atlantas, the Raleighs saw massive supply expansion where they're seeing their inventory growing 10, 12, 15%. Whereas, in the Midwest, it was pushing into the upper single digits. And now we're seeing that supply expansion in the low single digits, which is a little bit more normal. So we just had that wave of supply, and that put a lot of downward pressure on rents. A lot of these newer lease ups, the strategy is get it filled up so that we can get it sold, realize our exit, and move on, get on to the next development. And really that just put a lot of downward pressure on existing Class A assets. And it also put some downward pressure on Class C rents. There's such thing as it's called a filtering effect, where people will move up the rental spectrum, so to speak, where they'll move from a Class B property to Class A because the rent delta isn't that much with all this new supply. And likewise, people move from a a Class C property to a Class B. When I talk Class A, think newer construction, think something built in the last 10 years. When we're talking Class B, something that's probably built in the last 20 to 30 years, than Class C, something older than that. Older, more obsolete properties, Class C, Class A, more state-of-the-art finishes, amenities that a lot of modern renters would find attracting and appealing. So that's kind of the long and the short of it. Is just really all this supply over the last few years really put a lot of downward pressure on rent growth. And we'll kind of get into our predictions for 2026 here in a moment, but expecting that to work in our favor in the coming years.
Good stuff. Thanks, Thie. Jim,
Yeah,
I know you wanted to add a little bit.
Yeah, real quick. The question also kind of mentioned affordability was that part of the issue. Within our market selections, if you look at where we are active, our rent to income, the income to rent ratio is really favorable. We really look at markets that are in the 20 to 25% range max, compared to some of the coastal markets and my beloved Chicago, where those numbers can really be up in the 40 to 50% range. So our residents have a little bit more room, even though they don't love rent increases, to absorb it a little better. So that was all I really wanted to add.
That's great. Great question. There's a few questions on kind of 2026, and I know Ryan, you just mentioned we'll get to those. So just want to acknowledge those who put those in. I see them, and we'll get to them here in a minute.
Nick, I think there's a rent growth BAM markets Midwest slide. Can you get to that, please? Might be the previous slide. There we go. So these again are active markets where we have existing assets, where we plan to scale, and where we're getting opportunities. And this, I think, really shows the slight pullback from a major, on the national scale, major metros. This really shows the pullback in 2025 because of that supply. So you see a slight dip, but not to the scale, what Jim and Ryan were just talking about, not to the scale of a Chicago, Austin, San Francisco market, like that. So see a slight dip in 2025. We're expecting to rebound in 2026, and that all the evidence in that is all due to the supply drop off. So these markets that we're in, Indianapolis, Des Moines, Kansas City, Northwest Arkansas, and Pittsburgh, they all have, one thing in common, and that is they are fundamentally strong. And in terms of occupancy, in terms of which is an indicator of demand, and then in terms of rent growth. And so not only do we have high occupancies within these markets, they are also pushing rents, whereas nationally rents are either staying the same or backing up. So our projection for 2026 is really, and especially the second half of 2026, is that rents will increase in each of these markets and then continue to increase into 2027. And Nick, that's really, I'm happy to, if anybody has a question on any of these, I can dive back into them. I guess before I close out, I do want to give a special thanks to a few of the sources here: CBRE, MMG, Cushman & Wakefield, Walker & Dunlop, Colliers. They all provided data and input in order to put this presentation together. And again, that goes back to our strong relationships, that they're willing to do that for us.
Yeah, it's great. Thanks, Alec. Another question came in that kind of fits within this in terms of rent and increase and occupancy decrease. What's the typical length of time that tenants are renting? Is that increasing? Is it shortening? Does it vary? Can you tell us a little bit about that?
I'll take that one.
There you go.
Knee-jerk answer is 12 months because that's how long our leases typically are. Usually our retention on average, and this is both BAM and kind of the industry, ranges anywhere from 50 to 60% of residents annually renew. So that it fluctuates from there. But I mean, generally in the Class A space, you're going to see a little bit more turnover because you've got a more upwardly mobile demographic. But at the same time, the it's a better opportunity for rent increases, especially on those newer leases. Um, at the same time, and this is something I heard in NMHC, that a lot of renters are typically trying to stay longer. They're realizing that the cost of moving is becoming more and more over time. Um, in general, and just the cost of living, where they're wanting to stay longer. So really, I think for us as an operator, that certainly puts an emphasis on the resident experience, which is always a priority for us. But at the same time, that's, opportunities to manage revenue on that renewal piece are really important. And anecdotally, a lot of folks are looking sooner when they are looking to move. They're more proactive because they typically have to give about a 60-day notice before if they're going to move out. So a lot of folks, and we see this on new leasing traffic, where folks are looking now when their lease isn't up until June or July.
That's good. Thank you. Going back to Alec touched on it. He started it with some predictions on 2026. Jim, do you have any additional predictions that you want to talk about?
Um, I think that, based on what we've been talking about with the reduction in kind of new supply, I think the supply demand and, hopefully rent growth accelerating throughout the balance of 26 and into 27, I think it kind of sets up as being a good time for us to buy. We think that good investors can make money, through the ebb and flow cycles of the normal real estate market. But this might be one of those times when it's just a little bit easier. So, we're rather bullish on our outlook for the Fund 5 assets that we just acquired. I think the proof is in the pudding, right? So to speak, Ryan. The early indications for both Hayden Flats and Kinsley Forest are very positive. We're exceeding or at pro forma on both of them. So again, I think it's a time where we're bullish looking forward in the near term. Obviously, geopolitical or other shocks to the economic system can change that. But I'm having sunk my whole career in commercial real estate. I'm a firm believer in real assets and as a part of a normal investment strategy. So.
Yeah, awesome. Ryan, Thie, anything you want to add to 2026 predictions that Alec and Jim haven't touched on yet?
Yeah, I think we kind of buried it in there. Yeah, we're bullish that rent growth is going to kind of regain some momentum. And I think by that, I don't mean all of a sudden it's going to flip back to 10 and 12% like I was alluding to that we were seeing in 2022 and 2023. I don't know if we'll see that in my lifetime, to be candid. And I don't know if that's sustainable anyways in any market. But no, I think rent growth will really continue to pick up steam. I think it'll be a little bit more backloaded this year as product absorbs, especially in the summer. And I think that sets up well for 2027. But I think what we will see in the first part of this year is we'll see concessions ease. And I think we'll also see some strategic, and we're already implementing it now in our portfolio in real time, just strategic market rent increases, especially on floor plans that are very much in demand across our assets. We're not as, and that's kind of the front end of really starting to push rents.
Yeah, I was just going to say, as we're talking about all this, from both the macro to then to the markets that we're in and that we focus on, and some of these predictions, what does that mean for us? What does that mean for our investors? What can they be thinking about, be expecting, hoping to see at the same time?
I can jump in on that. I mean, look, we're continuing to execute our business plan on all of the assets in our portfolio. I know that our investors are always wondering about our hold periods, and generally when we acquire an asset, we're really looking to hold that property 3 to 5 years. If we construct an entire portfolio, that can mean that the fund itself might go 4 to 6 or even 7 years. I think that sometimes the capital markets line up where it's not a great time to be a seller, but it doesn't mean that we're not selling assets. We're always a market participant. We're always looking to buy and sell. and certain assets in our portfolio that, that we've executed the business plan. We are selling. We closed one earlier this week. We put another under contract. Um, the one that we closed was in Fund One. The one that we put under contract is in Fund Two. We're continuing to work the Fund Three and Four assets as well as the others, and the rent growth that we talked about affects these assets as well. So, improving our fundamentals, executing our business plan, you know, just because it's a good time to meet a buyer, it doesn't mean there's ever a bad time to make a good profit for our investors. So, we are looking to constantly, improve what we're doing at the project level, which is why being an integrated manager and hands-on operator is really important to us.
Yeah.
So,
Before I jump to you, Alec, real quick, just to level set for all those who are here, because I know we have a cross section of folks who are here, from people who have been investing with us for a while, with people who are just learning and in conversation, and maybe a few of you who are kind of been following, got some marketing stuff from us, but never talked to us. We have funds. So when Jim is talking about project level and then fund level, we're not just, as an investor, you get to invest in a fund, right? Diversified across a bunch of assets, a ton of doors that we're operating each of those projects, and you're a part owner of all of those. So within that operation, as Jim alluded to, right? And I think we had one question early on of, hey, still 3 to 5 timeline that we're working towards. Well, the project level, absolutely, and depending on the variability of that, might extend a little bit more, but we always want to sell them faster if we can. It just depends on how quickly can we improve those assets and find the right buyers and the right timing to do that. So just wanted to drop that real quick, just to give a little context and anchor for those who might not be as familiar. Alec, you want to jump in on additional thoughts?
Yes, I really just want to emphasize that while we think this year and 2027, it's a uniquely strong time to buy. But what that means for us and our we're not going to sacrifice our discipline, right? Our analysis, our underwriting, our strategy, because we think it's a good time to buy. We are going to remain disciplined. We will always be good stewards of investors' hard-earned money. So I just really want to emphasize that and how we're doing that. So a lot of the examples, a lot of the data that I was feeding was at the macro level, and what's incoming supply in this market, rent growth in this market, occupancy in this market. But that is all very useful data. We go down to the micro location, right? So if we see an opportunity, we're focused. All right, what's within this 1 mile radius? What's within the 3 mile radius, right? And so on. And we really focus down at that level. Where's new construction? Is it justified? What's rent growth been like the last few years? We take a very disciplined approach, and so while we feel very strongly that this year and this time is a uniquely strong time to buy, just want to emphasize we will remain disciplined on that front. So opportunities that we are bringing forth to investors are opportunities that have been extremely vetted.
Yeah, great. Thanks for saying that, Alec. Okay, a couple questions. We got about a little more than 10 minutes left. So we've had a few questions and we left 10 minutes for Q&A. So there's a handful here in the chat already. And so if you're still here and you've got questions, pop them in. Would love to answer those as well. So one from Sean, he asked a long time ago. He's very patient, but I think now is the right time to answer it. What does the market look like for selling an asset or two in 2026? Particularly Fund One is called out. And Thie, I'm gonna kick this to you because the latter half of the question is, I know Greenfield either sold or is in the late stages of being sold.
Well, Jim buried the lead, but yeah, we did close on the disposition of Greenfield Crossing yesterday. That's an asset in Fund One that we acquired in 2019. It was a really successful project for us. We'll be proud to share more final return numbers with our Fund One investors here in the very near future. But yeah, that did close yesterday. Always feels great to take these full cycle, simply said. And then Another one that we got under contract probably an hour after Greenfield closed was Waterstone at Green River in Evansville, Indiana. Really great asset. It's been good for us, but to Jim's point, found a great time to turn a profit for our investors, and we feel that this is it. We went through the marketing process last fall, didn't quite yield a buyer, but we were actually able to continue to work it off market. Our broker partner was, and they found a really good buyer at terms that we feel are favorable to us and our investors and fund too. And excited to see that materialize. Hopefully here in early Q2, I'd say is when that will look to close. And then
Awesome.
also, I'll keep it going. We have one more that is under disposition. It's not new news, but Nantucket Cove. It's a single asset. It's in Champaign, Illinois. Got that under contract right at the beginning of the year. It's a HUD assumption disposition. The buyer is assuming the underlying HUD loan that we originally placed on the property not too long after we acquired it. And HUD is a government agency, so you might know where I'm going with this, that anytime something is in a government agency's hands, time might be your enemy, or it may be to our advantage, actually. And this buyer, knock on wood, has actually been really good to work with. And I also have a lot of confidence that the servicer that's kind of helping with the process, Merchants Capital, is our go-to lender. So we have a very good relationship there. So I feel optimistic that that process is going to continue to move forward, and probably look at that closing later this summer, conservatively. But BAM's record on an acquisition HUD loan assumption back when we used to do those was 92 days. I'm hoping this one knocks that off. I'll take 91 days.
That's
from
great.
PSA signing to closing. And usually it's about 4 to 6 months is usually kind of the horizon for a HUD loan assumption from PSA execution when the whole process starts, DD, buyer getting their application into HUD to assume the loan, and then it takes a couple months for HUD to approve it. So it can be done, but more updates will be given to those investors over time. But overall, as Jim mentioned earlier, we're going to continue to evaluate our portfolio strategically, and we're going to continue to stay out front of the market as best we can, especially as fundamentals we feel anticipate changing favorably, that it could provide a good opportunity for us to look at taking more assets full cycle in this year and in coming years.
Yeah, great. Well, that spurred a couple questions, Ryan, about dispositions, particularly on Fund 2. Joel, good to see you, Joel. Your name here. Will Fund 2 see a larger distribution with the sale of the asset in Fund 2? And I'll say yes. The answer is yes. But Ryan, anything you want to say beyond that?
Nothing to add to that.
Okay.
Yeah, simply said.
Yeah, great. More to come on that,
Yep.
Joel, as we get more information. As that is very fresh news.
That's an exclusive for those of you that logged on during your lunch hour.
That's right.
You're welcome.
That's right. Yeah, we haven't told anybody yet, except you all. So, congrats. A few here from Austin and Sean, kind of same realm around ground up development opportunities. So, there's two, it's two kind of a two-part. What's the outlook on ground up developments? We've been dipping our toes in from what they've seen. Those have been, he says, panned out very well. They're going according to plan. None of them are, too far along. Just to moderate that a little bit, Sean. We're, a couple years in. One's in lease up, and a couple are still being built. But then Austin, kind of on top of that, asks about any new opportunities on that, or should we just continue to add to our Fund 5 positions?
Well, we are continuing to look at new development opportunities. It's an interesting time for development. I think that prices have risen. Rent growth for the last couple of years has been a little bit muted. So we're trying to thread the needle and find deals that satisfy both the requirements for returns, but then the most important thing, a development partner that we know and trust. It's an important fundamental, since we are not developers ourselves. We know what we're good at. That's not one of them. When we put a deal in front of you that's a development deal, it has to be with a developer that we know and have a relationship with, that's deep on the trust end of the spectrum. So I don't know what the absolute timing or outlook for that is. we may or may not have one again this year. So if somebody, needs losses and growth for their capital, I would encourage you to look at Fund 5.
Yeah, great. Two more, that are here, at least at the moment. Um, there's a question about kind of historical. So, might punt this to you, Thie. What's the worst deal you've had in the past couple of years, and did you have a forced sell or refinance?
Are we talking worst deal all time or?
But they said the last couple of years, so you could do both because you probably know
Yeah,
both sides of that.
I mean, well,
I'm really excited for this answer.
Yeah, no, I mean, I'll give a deep cut there, and this wasn't a syndication or a fund asset or anything, but it was one of Ivan Barrett's first personal rental properties. It's an apartment community on the south side of Indianapolis, a little enclave near downtown Indy called Beech Grove. It was a little 35 unit deal, and I think he clipped a 7 IRR on that on a 7 year hold. We haven't come anywhere near that bad in recent times, but nothing that we've been forced to sell or refinance. I guess of all our realized exits, Mad River Apartments in Dayton, Ohio was our worst. And that was I believe a 17 IRR on a 7 year hold, which I think we'll take that all day. I mean, that's a strong return, and Dayton wasn't a super liquid market. That was a market when we got into it in 2017. We were really hoping that we'd expand. It was our first out of state acquisition. It was a great economies of scale play, great piece of real estate, well located, and it ended up exiting the asset in late 2024. Just realized that we weren't going to be able to scale in that market. We'd still done pretty well for it, and it really extracted all that we could out of it in terms of NOI growth and upside, and sold at that time. And wish we could have sold it a couple of years sooner when pricing was a lot better for that kind of an asset. I think the returns would have been even better, but we put it on a longer term agency product that had a much higher prepayment penalty than what a lot of our loans are currently, where it was a yield maintenance. And when rates were really low, that crushed us on what that prepay would be. So I'd say Mad River was our worst deal that we've had, that we've realized an exit on in recent memory. But all things considered, I mean, that's really strong given that our average is 30 IRR and what are we at, a 2.6 multiple, Jim, on our
2.4.
yeah, two dozen plus realized exits. We're targeting a 15 IRR or better and a 2x multiple, looking to double your money in 5 years, call it.
Yeah.
Yeah. Awesome.
Can I jump in on that? I mean, I think what that question was sort of touching on is how often does BAM run into trouble? And we are a market participant, so what that means is that a project can open up next door any day. Interest rates can rise any day. Stuff happens, and we're here to work on it, and that's why you trust us with your money. It is part of the business. Anybody who tells you that they're coasting along or this business is easy is not telling you the truth. It's a lot of work, and we react to things that happen every day.
Yeah, I mean, I could have said it better, Jim. And when we go to sell a property, Alec's our acquisitions guy, I'm our dispositions guy, to keep it simple. Nothing to take away from what he does. You would think an acquisition is a lot of work, a disposition is a ton of work. It's just as hard to land the plane on that as an acquisition. And again, when we take these full cycle and get the plane landed, it's a great feeling. And when we're doing it, it means because we have a high level of conviction that it's what's best for our investors and their money.
And it's a team effort.
Yeah.
Yeah, love it. Awesome. Okay, we're at time. So if you're like, I'm done with the lunch, I got to get back to work, feel free to hop off. We're recording this, so we'll send this out to you afterwards. There's one more question, and if anybody wants to stay, we've got a few extra minutes. We can stay for a few additional questions. There's one that Chris Bradford asked, and everybody, all the rage, right, guys, is AI out there, and how does it help us do just a little bit better work? Can we take some of the menial tasks off? Can we consolidate some of the work that we're doing to make us more effective? So his is around our utilization, any opportunities to reduce cost structure, drive increased revenue, source, analyze new opportunities, et cetera, et cetera. So I don't know who wants to take that one first. Thie, you want to take that
A
first?
lot of these are bouncing my way because I mean, asset manager, my role, I'm kind of the conduit between BAM Capital and BAM Management. So I interact a lot with our property management folks. And naturally, these questions are kind of my wheelhouse. Not to take away from Alec and Jim are both awesome at what they do. I just have a little bit more exposure to some of these subject matters. But as far as AI goes, it is something we're actively implementing strategically. Of course, there's a ton of AI out there for just about every facet of our business, and some of it's great, some of it needs some work, and everything in between. But we recently switched property management softwares within the last 12 months, or coming up on about a year, and that platform has had some AI functions that can help us with really, I mean, one of them being training and quality control on the kind of the storefront, if you will, with leasing and responding to prospects, keeping leads warm. Because if you think about it, a lot of folks that rent at our apartments are working during the day and they're not spending their time at work looking at apartments. They're looking at night. So there's a lot of really cool technology that helps with that overnight leasing. That when our folks are not at their desks or at their phones, and we have a great culture and believe in a work life balance. Our folks aren't saving lives. They don't need to be on call 24/7 unless they're maintenance for absolute emergencies. So that's been a cool thing with what just a lot of that's come through with AI. I think there's some things I've also automated just processes internally with paying bills like that.
Mm.
Um, that's been a godsend with just making us a little bit more efficient. I mean, we're looking at more stuff we can implement on the asset management side with managing revenue, with getting out front of trends in the portfolio. So there's a lot of potential, but we're very carefully vetting it because AI is a new shiny thing and it's great, but we want to be strategic with our investment there. But we do see a ton of opportunity, and even just with Gemini and the Google suite. I mean, what it's done for some of our folks on site with just some of the ad hoc marketing efforts they do, and they've just had a lot of fun with it and leaned into it. And anecdotally, like that's another thing I take away from NMHC on the ops side is that really a lot of these newer apartments they're all nice, they're all new, they all have nice new amenities, they've all got stainless steel appliances and stone countertops, but really the biggest way you have to differentiate yourself is the experience. And our one of our core values at BAM is fun, quirky spirit, and I've seen a lot of that being leaned into with folks playing around with the AI to create new marketing flyers and memes and all kinds of stuff that's out there. But it's really exciting to see. I think I feel like we're on the leading edge of that and helping our operations get better.
Love it. Thanks, Thie, on that. Uh, I think I think we've hit it all. If I missed your question, you can send me an email and be like, Nick, you missed me. But I think we hit them all. Or if you have any final takers, drop it, raise your hand, speak now or forever, hold your peace. Going once,
Hey, I've got
going.
something.
All right, Austin. Hey, good to see your name.
Yeah, it was mentioned because I asked the question about, hey, hold on for a ground up or just go ahead and put into Fund 5. And it was mentioned, I don't know if it was meant this way, but it was mentioned. So if you're looking for some losses, go ahead and put some more, continue putting into Fund 5. But is that just tax write-offs or Fund 5's looking bad?
No, no. Thank you. Thank you for asking that. I don't want to leave that ambiguous.
Yeah.
No, tax losses to potentially shelter other passive gains that you might have.
Okay, that's what I thought, but I
Yeah,
wanted to just clarify that a little
for
bit.
sure. No, thank you.
Yeah, great.
Okay.
That might have been the best question of the day.
No doubt.
Scared me just for a second.
Yeah, and maybe the clarity, yeah, beyond that is, I think Alec and Thie maybe have alluded to it. The two first assets that we have in Fund 5 are performing exceptionally well out of the gate. And maybe Alec, if you want to just touch on that real quick for those who are still here, I think that's a really
Yes.
prescient point.
Yeah, I can. I know Jim alluded to we're already at or exceeding our pro forma, and I actually just got a message while we were going through this that. So I know that on Hayden Flats in Bloomington, which we closed in October of 2025, first asset in Fund 5, we are exceeding our pro forma there. which typically when you take on a new acquisition, Ryan can speak, better on this, but typically there's a 3 to 6 months dip in operations. It's really just us trying to get our people, our branding in there, get it under the BAM umbrella, and that takes time, and with Hayden Flats, we are month 5, and we've already exceeded our pro forma, and that was realized first month, third month, and now it's continuing on that trajectory of the 5th month. So when we looked last week, we were about 10% over our year 1 NOI that was originally set when we established that asset supplemental. So really strong start at Hayden Flats, and then at Kinsley, the story remains the same. It's a out of state market for us. Luckily, we have Altitude 970, which is a Fund 4 asset within 10 minutes of Kinsley. So that scalability of having an existing team in a out of state market really helps. And that's proven true on Kinsley Forest. So we are already exceeding our pro forma. When I looked for last week, it was by 4%, and we closed on that in December. So again, full month under ownership, and already exceeding our pro forma. When traditionally in this industry, you see a dip when there's a transaction that takes place.
Awesome.
And
Thanks, Alec.
add to that, common thread between these two assets already in Fund 5 is that there's no new supply in really a 5-mile radius, Alec. Nothing that's immediately that's planned or coming out of the ground, which sets up really well for us for the next 24 months at least.
Right. And that's why, when I mentioned before, we're so disciplined in our approach. We intensely focus on that. And in Bloomington, where Hayden Flats lies, I think there were 50 units that were under construction, but those were for Greek life at IU Bloomington. So doesn't really compare. It doesn't really apply. It won't affect the Class A market rate asset of Hayden Flats. And then Kinsley, there are about 300 units. I don't know the exact number off the top of my head, but there are 300 units, like 3 to 4 miles south, coming in 2026, and beyond that through 2029. Within a 3-mile radius, there is 0. And again, Kansas City, very strong fundamental market. So bodes well for the future performance of that asset.
Yeah, great. One thing on Fund 5, Vernon, and then question on Fund 4, and then we probably will wrap up. But we're always want to be available for further conversation with the person that you talk to regularly. Hopefully, you talk to somebody regularly here. If not, I drop my email in the chat. It's just nick@bamcapital.com. Always happy to help get you in touch with the right person on the team if it's not me as well. So wanted to say that. Vernon, your great question. Fund 5 is still open for investment. So clarity for everybody on the call as well here too, that Fund 5 we have our first 2 assets in there, but we're going to raise probably another, I think it's 160 million or so in the fund, and go buy, another, 7 to 9 assets, depending on how much we can buy with that equity that we raise. So Alec's constantly looking for great opportunities and great deals out in the market and in the places that we want to be. So it's still open, Vernon. I think you're talking to Sam on our team, so you can call Sam and talk to him a little bit more about that. Also, I'm happy to help as well, but still open for investment. You can still get in. Great on that. And then last one, and then we'll wrap it. Colt, good question. I think Andrew is your connection here. What are you seeing, Thie? I'm going to kick it to you. What are you seeing in Fund 4 and Jim, and how's that trending?
Well, Colt, we'll have quarterly reports out by this time next week, so we'll let those speak for themselves. But I'll candidly hit a few points. I think Q4 was some good, some bad with the fund. One asset that I'll start with the bad. Like Nice, it had a fall off in occupancy in Q4. So likewise, the Flats at Fishers. However, and altitude 97, or sorry, ascent 430 had a little bit of fall off as well. I'd say ascent 430 was largely a function of seasonality. For Nice, we saw just more aggressive temporary concessions at some of these other projects that are finishing up lease ups in that Whitestown, Lebanon submarket, Zionsville submarket, as well as a new project that came online in Zionsville. So just a little bit of pressure there. And then what was the third one I mentioned? Flats at Fisher is kind of a similar thing, just mainly seasonality. But for Nice, they've already really corrected that trend largely. I'm pretty confident they'll be back in the 90s here in the next 30 days, 60 days at worst. And that's just going into the peak leasing season where we're going to see more leasing traffic. And then bad news comes first. I start with the bad, but the good that we saw in Q4 was altitude 970 in Kansas City. Really tough first half of the year for that asset, and they really bottomed out in August. And a lot of just some people issues on site that, admittedly, we were too slow to correct. And fortunately, we did course correct. We've got a district manager, as Alec I think alluded to, that is based in Kansas City that's focused on altitude 970, Kinsley Forest, which is our Fund 5 asset in Kansas City, and then also Uptown Terrace, 3 hours to the south in Rogers, Arkansas, Northwest Arkansas. But altitude 970, I mean, they spent most of the year in the 80s on occupancy, and now they're in the mid 90s. We've implemented a good deal of price increases there. I don't know the number offhand. It'll be in the quarterly report just over Q4, and even a few here, increasing market rents, which in theory will translate to rent growth as leases turn over, as we wear on into 2026 with renewals and new leases. So really encouraged what we're seeing at altitude 970. That asset is on a bridge loan that's going to mature in August. And we're going to look at our options on that here within Q1 and make a decision if it's best to refinance the asset, expose the asset to the market, see if dispositions accrue to the fund, and what would be best for our investors. So really encouraged with the trend at altitude 970. What else am I forgetting on Fund 4? I feel like I hit all of them. 32 unit, another one that really struggled mightily last year on occupancy, just couldn't really get over the hump. We've got a really strong team there now, and they're trending into the low 90s. And I'm really encouraged by where that asset's going to be this year. So yeah, I think Fund 4, like we're still working through some known challenges, but I think overall that fund is going to continue to get better each quarter in aggregate, especially just really getting some things pointing in the right direction, especially at like an altitude 970 in Nice and ascent 430.
Awesome. Great stuff. Great questions. And just to wrap this up, put a bow on it, just for, again, anybody who's newer, or maybe just a reminder around, why we buy, what we buy, and what we're doing in the early days. We're buying these assets for the opportunity to improve their operations. So out of the gate, it likely will be a little bit rocky, right? On the occupancy, on the operations, on the right people in the seats, on the team, to really start to turn these assets around and get them in an excellent place that drives the value up over time, that net operating income. So increase, just like any business, you want to increase the revenue and you want to decrease the expenses, right? And that starts to provide the value. And of course, there's other levers in there that our strategy deploys and employs to help to support that. So that's kind of our bread and butter, what we do, and the people that make it happen on property under Ryan and his team's guidance is phenomenal. So kudos to you guys. Thanks for all the time.
Sorry, Nick. I got to throw one more thing on Fund 4, just because I think it is important, and I wish I would have baked it in the main thing. So for those of you, the 36 of you or so that are left, another webinar exclusive, but insurance, that's been a really hot button issue in our industry for 3 years. And we've started to see some stabilization in costs, but specifically Fund 5. All 6 assets in Fund 5 were rolled into a new master insurance policy that we originated back in November. Or Fund 4. Well, it does include the 2 assets in Fund 5. So good catch, Jen. Thank you. Got that out of the corner of my eye. But yes, all 6 assets in Fund 4, where we really saw some really rough insurance premiums at acquisition that exceeded our underwriting. Our average per door insurance cost in those Fund 4 assets was around $750 a unit. Typically, we're seeing like 500 units what we're underwriting, Alec. I remember the days when it was $350 a unit. But long story short, with this new policy, we're able to get the annual insurance premium down to just around $463 a unit. So a really material cost savings that's going to be realized in the financials in Fund 4 over the course of 2026. And that's going to help cash flow. That's going to help valuation. I think as we see insurance costs hopefully continue to stabilize in the multifamily market, I think that's going to be a great thing for all of us. So just want to throw that in there. That'll also be in the key report, but another market outlook webinar exclusive. Now you can wrap it up, Nick.
Awesome. Well, thanks, guys. This was phenomenal. Everybody, thanks so much. If you stuck around, thanks for staying. We also, if you have other topics or things that you would like to propose or hear from us, let me know. Let us know. We'd love to make sure that you are well informed as a partner with us and as a potential future partner with us. So thanks so much for your time, everybody. Jim Fox, Alec Bannister, Ryan Thie, thank you so much. This is Nick Meyer signing off, and we'll see y'all soon.
Thanks for your time.
Thank you,
all.
everybody.